Wow, have you heard the news? Less than 3 months into 2023, and already 3 of the largest banks in the US have collapsed. It's a concerning trend that's got people asking, what the heck is happening in the financial world? And with such major players falling so fast, the question of whether we're headed for a recession or even a depression is on everyone's minds. To understand how the recent bank failures may impact the broader economy, it's crucial to understand several key things, like what factors have contributed to these failures, and why weren't the government and the Fed able to prevent this from happening? And more importantly, what is the likelihood of more bank failures in the future? It's important to consider whether these bank failures could result in broader economic issues, as we've seen in the past. In 2023, the bank failures seem to share some common characteristics. All of these banks provided financial services for very specific markets. Just look at Silvergate and Signature, who primarily served cryptocurrency exchanges and investors, while Silicon Valley Bank, or SVB, focused on catering to tech startups. Unlike most banks, these banks held very large accounts, with the average bank account size in the US being $41,600 by a research from 2022. SVB's average account balance exceeded $1 million, and their services were out of reach for those with less. Their largest depositors held tens or even hundreds of millions of dollars. Similarly, Signature Bank, Silvergate Bank, and Credit Suisse catered to large corporations and wealthy individuals, resulting in large average account sizes. Unfortunately, this also meant that the majority of their depositors' funds were not protected by the FDIC, which only insures the first $250,000. For the average person with an account balance of just $5,300, this guarantee provides peace of mind against bank failure, and any losses would be minor inconveniences that could be reimbursed in due course. However, for those with large amounts at risk, these bank collapses have been a major blow. The Federal Deposit Insurance Corporation, FDIC, together with the Treasury and the Federal Reserve, issued a joint statement announcing their decision to provide unlimited coverage in this particular case, given the circumstances. Their statement also indicated that they would extend this coverage to any future bank failures that may occur in the near future. Many people expressed frustration that this was another bank bailout that taxpayers would ultimately have to foot the bill for. While this isn't entirely accurate, it's not completely false either. The Federal Deposit Insurance Corporation, FDIC, is, in fact, an insurance corporation that doesn't rely on taxpayer funds. Instead, it charges banks and other deposit-taking institutions for insurance coverage, which is necessary due to the large payouts it has had to make in the past. To cover the cost of its services, the FDIC plans to raise its fees for providing protection to other banks. These increased fees will likely be passed on indirectly to bank customers in the form of higher fees, lower interest rates on savings accounts, or higher interest rates on loans. Many people are worried that the banks, having been bailed out by the FDIC, will become more profitable and take even greater risks in the future, knowing that they are too big to fail. While these concerns are understandable, they are actually unfounded in this case. Silicon Valley Bank had enough money to cover its deposits, but most of its assets were invested in government treasuries. These treasuries are considered very safe, but their value goes down when interest rates go up. When interest rates rose, the bank tried to sell these treasuries to cover a lot of withdrawals, but failed. This was a risky strategy that did not work out, even if the assets themselves were highly secure. Even though recent bank failures have affected the stability of the banking system and caused many people to lose confidence in it, many economists are not too worried. In the past, bank failures have led to major economic downturns, but economists believe that this may not be the case this time around. Can banks be considered irrelevant in today's economy? Not exactly. Though they are less important now than in the past, they still play a vital role in the economy. One of their key functions is providing a secure place for people to store their money. When combined with modern technology like credit cards and electronic payments, this makes spending money easier and faster, which increases the velocity of money. This, in turn, can create more employment and benefit the economy. Banks are important because they help people and businesses borrow money. This means that if someone wants to start a business or buy a house, they can borrow the money they need from the bank. This is especially helpful for small businesses that might not have a lot of money to start with. When these businesses get started, they can make things or provide services that people want to buy. This helps the economy grow and can create jobs. Banks also help people save their money by taking deposits. This means that if you put your money in a bank account, the bank will keep it safe for you. The bank will also use your money to lend to other people who need it. This is called the money multiplier, because the money you deposit can create more money when it is lent out through a process called the money multiplier. When someone deposits $10,000 in their bank, and the bank has a reserve requirement of 10%, the bank can lend out $9,000 to someone else. The person who borrowed that money may spend it at a business, which then deposits the money into their own bank account. The business's bank can then lend out $8,100, and this process can continue until $100,000 has been created in the banking system from the initial $10,000. This is how banks operate in reality, although it may not always be accurate. In the US and most other advanced economies, when you give your money to a bank, they may use it to pay for things between different banks. Also, banks can make new money by lending it out to other people. This means they don't need to use all of the money you give them to lend it to others. The only limit on this is not how much money they have from depositors, but how much demand they have from borrowers who meet their lending and government criteria. Silicon Valley Bank invested in government treasury bonds because they didn't have many people who wanted to borrow money from them. The bank invested the money in government treasury bonds to earn interest instead of leaving it unused. The money multiplier is a concept that suggests banks can use deposits to make more loans, but the Federal Reserve says they must also have enough money to cover any withdrawals that customers may make. The world of finance is evolving at an unprecedented pace, and the role of banks is changing along with it. As alternative financing options and decentralized currencies gain popularity, the traditional banking system is facing new challenges and opportunities. This shift could potentially lead to fewer traditional bank failures, causing economic problems and opening the door for new, innovative financial institutions to emerging. With the rise of crowdfunding and peer-to-peer lending, individuals and businesses now have more options than ever before to access capital outside of the traditional banking system. At the same time, the emergence of decentralized currencies like Bitcoin and other cryptocurrencies is shaking up the financial world and challenging traditional banking structures. As we look to the future, it is clear that the financial industry is at a crossroads, with significant change and innovation on the horizon. The future of the financial industry remains uncertain, and only time will reveal what lies ahead.